So there are a few trends that I think I would highlight. One, so far from banks and
With me is Som Seif, President and CEO of Claymore Investments, which manages $6.3 billion in exchange-traded funds that are listed on the Toronto Stock Exchange. Welcome, Som.
Great to be here, Rudy.
Claymore's offerings include Claymore Canadian Fundamental Index ETF, which we'll be talking about today. Som, this fund doesn't track the S&P TSX composite, which is the most well-known index. What is it designed to do?
Well, I think it's very important to answer that question to understand Claymore. I mean, we as a firm believe that passive investing and indexing are very important. We think that the transparency, the low cost, the low turnover, are really important benefits of indexing. But we just don't think that market cap indexing or traditional benchmarks are the best way to invest for the long term. So what we instead do is we use enhanced indexes, such as the fundamental index, which is the basis for our Claymore Canadian Fundamental Index. Ultimately, what it cares about is looking at companies and the weighting of securities within the portfolio. So CRQ specifically weights companies based on its fundamentals. So a company's four factors being cash flow, total sales, total dividends, and total book equity value. And by using that, what you're doing is, instead of using market price or market cap, you're weighting based on a company's size in the economy and delinking price and weight, which is the biggest issue that market cap weighted indices have and the biggest benefit that fundamental indexing brings to the table here.
I'm glad you mentioned fees. 69 basis points is the MER of this ETF. Now that compares very favorably with the median in the Canadian equity category, which is more than triple that amount. However, as far as the ETFs go, this is one of the more pricier, if I could call 0.69% pricey, that your competitors in the ETF space have Canadian equity ETFs that are a lot cheaper than yours. So what's the justification for that?
Well, I think there's a couple things I'd say to that. First off, I think the value add of the fundamental index is really critical here. There's a lot of things that are going into the concept of the development of this idea, and the performance of the product has been, net of fees, outperforming the benchmark. I think the second thing is comparing it to the active and the indexing is important because we are doing indexing here, we're doing passive, but we believe that ultimately we can capture a large part of what the active money managers bring to the table through its fundamental approach. But really the big value add also comes from the reduction of cost versus active money management. And as CRQ has performed, it's beaten the majority of active mutual funds in Canada, not only just the benchmark, but the active. I think the last comment I would say about this is, when you look at comparing to a benchmark index like the S&P TSX 60 index or whatever, there's lots of products that charge 10 basis points, 17, 20 basis points and such. The reality though is if it's a bad strategy, then it doesn't matter how little they charge, it's a bad investment strategy. And I'll give you a great example. If I walked in the room here today, Rudy, and I asked you, I've got a great new strategy. I'm going to charge you 10 basis points for it. Every single time a stock price goes up, I'm going to buy more of it. And every single time a stock price goes down, I'm going to sell it. The reality is that's what the benchmark index does every single day. And so it doesn't matter if it's 10 basis points or 50 basis points or 200 basis points. It's a bad investment strategy for the long-term investor.
Yeah, well, I think traditional indexing is still going to have its fans. That said, you're to be congratulated for the Morningstar 5-star rated performance of this ETF over the most recent 5-year period ended in March. Wanted to point out, though, that this fund isn't always a market beater. It lagged in the most recent 12-month period. Are there markets that this fund tends to do better in and worse in?
Well, I think it's a really important point. First off, when we look at fundamental indexing, there's going to be periods of outperformance and underperformance. What we look at, though, is over 3 to 5 year cycles in the market, is it going to outperform? And that's really what the critical benefit of this product will be over those longer cycles. There will be 1 year periods as such that it'll underperform. But where it does its best is during flat to declining markets. During bull markets like we've had in the last 12, 18 months, it's done very well. It's kept up with the markets. But the reality is generally what you're going to find is it's going to be in and around the market or a little less. But when the markets are falling, the downside capture is very critical. And if you actually look at the long-term history of the index strategies, its upside capture is close to 1, its downside capture is significantly less than 1. And so that's really the benefit. A lower risk strategy, longer term, it's smoothing out the variations in the market between growth and value cycles. and really a great long-term neutral strategy to get exposure to the Canadian equity markets.
Yeah. Sector concentration, it's generally high in the Canadian equity market, also high in the Claymore ETF. You've got more than 3/4 of the assets of this fund in financial services or resources-related stocks. Should that be a concern to investors?
Well, I think as Canadians, we have three major sectors in anything. So if you're investing in the Canadian Fundamental Index or the benchmark, you're going to generally have a large exposure to energy, materials, and financials. In this case, the Fundamental Index has a higher weighting towards financials and a lower weighting towards energy and materials. So the reality is that's the makeup of our economy. I really look at this concept as, again, it's investing in companies and their fundamental basis in the economy. So how big is a company in the economy, and how big is an industry, therefore, in the economy? And that's, therefore, how this falls apart. There's no stock selection. There's no active money management decision to tilt or weight. It's really looking at the companies in the economy and what's their importance in the economy, and that's how it all falls out. So I think we're comfortable. Ultimately, I would rather have more of my money in companies that have strong cash flows, big revenues, and big book equity values than companies that have big PE ratios like you would have in the traditional benchmarks.
Som, thanks for your comments. For more on this ETF, you can go to claymoreinvestments.ca. The ticker symbol is CRQ. And of course, you can go to morningstar.ca. Thanks for watching.